What's up, everybody? Nate here, and the Federal Reserve will decide on the next moves for its monetary policy this week. To hike or not to hike? That is the question. The Federal Reserve has made a big impact on our economy over the last few years, and in 2022, they started to raise their benchmark interest rates up from 0%. However, by the end of last year, they were starting to slow down their hikes from 75 basis points all the way down to 50, and now many people are wondering where are they going to head next. Several Fed governors said they would be in favor of actually lowering their hikes from here on out to 25 basis points down from 50. Others have said the Fed needs to continue to raise rates even higher, and many think the Fed needs to actually lower rates right now. So today I want to talk about what the Federal Reserve could do next at their meeting later this week, what this means for investors, and how all of this is going to affect the consumer and our economy in 2023. So like I said, back in December 2022, the Federal Reserve actually slowed down the pace of its rate hike. So instead of raising them by 75 basis points, it only raised them by 50 basis points. And the reason being is because it believes that it is making a significant impact on inflation right now. We have seen inflation drop from 9.1% back in the summer of 2022 to now only around 6.5%. So that means that the Federal Reserve is raising interest rates enough to kind of bring down demand in our economy, so inflation also drops. But here's the thing, while inflation has come down for a lot of different things in our economy, we are still in a high inflationary environment. The Federal Reserve likes to keep inflation around 2%. So that means that even at their last meeting where they slowed the pace, they said that more interest rate hikes were going to be needed in order to bring down inflation. They have seen some positive effects, but they are definitely not there yet. That means we can expect the Federal Reserve to most likely continue to raise its interest rates until inflation comes way down to their target level of 2%. Right now, it's at 6.5%, so they have a very long way to go. However, with inflation coming down so quickly, there's been lots of speculation that the Federal Reserve has begun its pivot, meaning that it's going to slow down rate hikes and actually reverse on its policies, lowering its benchmark interest rates sometime in 2023. Now, we don't know exactly what direction the Federal Reserve is going to take just yet. We know that Federal Reserve Chairman Jerome Powell has been pretty clear that the entire Fed wants to bring down inflation as quickly as possible and make our economy go into something called a soft landing. That means essentially that they raise their interest rates high enough to where inflation comes down, but we don't go into a really bad recession or worse. The one thing you need to understand about the Federal Reserve and its monetary policies is that its goal is to kind of control inflation in our economy. Normally, we have inflation of around 2%, and over the last couple of years, inflation has exploded because of, well, the pandemic and lots of stimulus and supply chain problems all throughout the world. Keeping all of those things in mind, it's now the Federal Reserve's job to kind of look at inflation and keep it steady in our economy. They don't want zero inflation, but they also can't have inflation running rampant throughout our economy. The Federal Reserve needs inflation. It needs inflation because we need to continue to expand and grow in our economy. We need new money to kind of fuel our industries, to fuel funding. We can't just have the same amount of money all the time, because that means that certain groups of people and businesses are just not going to get it at a certain point. So the Federal Reserve continues to expand our economy. They continue to reinvest by printing a lot more money. And when this is controlled, it doesn't drastically affect our economy every single year. Typically, Americans can account for this by getting a small raise at their jobs every year. Like, I'm sure you've heard of the 2% raise before. That is typically what businesses and companies are going to give out as a raise every year, because that is what inflation is. So Americans make more money, and that is a good sign because now Americans can go out and buy more. But when you have inflation getting way out of control, well, now the value of your money goes way down, and you need a whole lot more of it because the buying power has also decreased. You have to go out and spend a ton more money to buy all of the same thing, and that hurts your money on a global scale. The United States dollar is the reserve currency of the world, and if other countries believe that it's not very valuable, then they're not going to invest in it. They're not going to want US debt, and eventually they're going to go to other currencies. The Federal Reserve cannot let that happen because I don't know if you've noticed, the United States has a debt problem. One of the only reasons why the United States can continue to have a debt problem is because we are the reserve currency. Other nations want to take on our debt because our money is so valuable. But again, that only stays true if the United States remains the reserve currency, which means inflation has to go lower. So like I said before, the Federal Reserve is in control of inflation, and what that means at a fundamental level is that the Federal Reserve is in control of our monetary supply. They tell the Treasury Department how much money actually needs to be printed and then produced and sent out for the entire country. Ultimately, that means that they're in control of demand, and then that demand is directly proportional with their interest rates. Basically, what you need to know is that where people get money from, like banks, financial institutions, and other places, well, that money is borrowed, and that money is borrowed from the Federal Reserve. Banks get this money and then they loan it out to you, and if banks have a really hard time getting that money from the Federal Reserve because inflation is high and interest rates are high, well, then that means that they're going to raise their interest rates, which affects the American consumer and everything else in our economy. It affects the rate at which we spend money, which is our demand. So the Federal Reserve can lower their benchmark interest rates, which sort of expands our economy really quickly. It means a lot of money needs to be printed because all of these businesses are investing, consumers are spending, and there's just a lot of economic activity. Or they can raise their interest rates, which means all of that money gets sucked out because it's really, really difficult for consumers and investors to spend money. That is the exact situation we are in 2023. The Fed is continuing to raise its interest rates because it wants to suck out all of that demand in our economy right now. The question is, how high can they actually go before it's a detriment to our economy? Like I said before, they want to suck out demand, and over the last couple of years, demand has been really high. They need to now bring it down so that way inflation and demand comes down too. But we still need consumers and investors spending money in our economy, or else everything comes to a grinding halt. And that is the fear that investors are having right now with the Federal Reserve's interest rates. These hikes directly affect investors, more importantly, investors in the stock market. The stock market, when you really think about it, is just a market filled with businesses. These businesses have plans to expand, and they have revenue that they have to keep up with in order to keep their hiring and keep their employees, and more importantly, just their businesses going. In a really, really high inflationary environment, well, you'll typically see businesses make a whole lot more money because they have to raise their prices in response to inflation, and people will make a lot more money. So everything sort of gets pushed up. But again, this is a big problem because it means the value of your money is going down, and it creates an endless cycle of businesses giving out wage increases, and then people spending more, and then businesses raising prices, and then giving out raises again. So that can create a big problem. But with the Federal Reserve raising its interest rates, well, that means that businesses are not going to be able to get as much money because consumers aren't spending as much. But now that we're sort of headed in the direction of a low inflationary environment with really high interest rates, that means businesses are going to be directly affected. Think about that cycle again for just a minute here. If you have people not making enough money and then they have to ask for a raise at their job in order to spend more money because everything costs so much right now, well, eventually that just gets out of control, and then businesses have to continue to raise their prices over and over and over again. What you have is an uncontrolled market without price stability. However, once price stability is met, then consumers for the most part should have the money in order to meet their means, which means they can go out and spend and buy things at a reasonable rate. That again will bring in that business expansion. But remember, inflation still isn't quite there yet. We're still transitioning from a high inflationary environment to a low inflationary environment, which means consumers just don't have the money to go out and buy things like they were in 2020 and in 2021. So businesses are not getting that consumer spending anymore. They're not able to make as much profit, and that hurts their bottom line and their business overall. And it kind of hurts their ability to grow in the future. Not only that, but some businesses just are not going to be able to survive because consumers aren't buying things. They're going to go under, which means that stock or that investment also flatlines. With businesses affected in such a negative way, well, investors want to get the most return on their money. So they don't want to invest in a company that might not be around because they can't get any sales right now or isn't going to see any growth for a few more years. Instead, investors are holding on to their money. They're not spending it. And when a company does have a really bad earnings report, or when a company says that it's going to go bankrupt or it's going to merge, well, that can mean some huge volatility in the stock market. They want to keep all of that away from their bottom line. Investors don't want to lose money, just like businesses don't want to lose money either. That hurts our entire economy too. So bottom line here is investors are afraid of the economic conditions that we're in, and more importantly, they're afraid that the Federal Reserve might feel like they have to do too much in order to bring down inflation even more. Like I said, the Fed has had major progress when it comes to bringing down inflation thus far. However, it's still highly elevated, and that might mean that they have to go even further in order to bring it down. And that might mean businesses get hurt even more and investors want to pull back. Now, investors are going to be negatively affected if the Federal Reserve continues to raise its interest rates quickly and aggressively. But if we see the Fed actually pull back a little bit and only have something, say, like a 25 basis point hike, well, that could mean that they're starting to pivot. And when the Federal Reserve pivots and slows down its interest rates and then lowers them, well, that means that we're going to have that economic expansion and boom once again. That could fuel a ton of investments in the stock market and other markets because investors believe things are going to be going up very soon because the Fed is starting to pull back. They are lowering their interest rates, which means that you're going to see a lot of economic expansion and you might see a little bit more inflation, but only if it's controlled. At the end of the day, investors want to see the future of our economy. They want to see the future of businesses pan out very strongly. And if they have that feeling, then they're going to invest a lot, which is why this next meeting is so pivotal. Consumers are also going to be affected by these interest rate hikes because everything that we spend has to do with the Federal Reserve in one way, shape, or another. Mortgages and those interest rates may end up going up if the Federal Reserve raises its interest rates in any way, shape, or form. The same with auto loans and the same with your credit card spending. All of those interest rates for your credit cards may go way, way up the higher the Federal Reserve sets its interest rates. That creates sort of a big debt problem for the vast majority of Americans, and debt has been growing because inflation is up. Many Americans can't rely on their own wages to get the things that they need or want, so they're relying on credit cards or loans instead. The bottom line here is that those interest rates are going up, making that debt a whole lot more expensive to pay off. That could further hurt Americans' ability to pump money back into our economy, and again, that could cause a minor recession or worse. Furthermore, it's going to deplete all of those markets I mentioned before. Like, people aren't going to be able to go out and get a mortgage if mortgage interest rates are really high. Millions of people are going to be completely barred from getting a mortgage simply because interest rates are higher. What you need to keep in mind is all of this, yes, every single thing is designed by the Federal Reserve. They want businesses to lay off people in order to cut costs. They want businesses to spend a lot less money. They want investors to not invest as much, so asset prices go down. They want consumers to not be able to go out and afford as many things right now. Above all else, they want everything, every single thing in our economy to either stop going up in price or to go down in price. And the Fed has said that this might cause some pain in our economy. It's basically like a huge reset because in the Federal Reserve's mind, well, our entire economy has been highly elevated for so long unnaturally, and it's gone beyond fundamentals, which means it kind of needs to be reeled in at this point. So in their eyes, while things might be falling in our economy and we might see a recession, it won't be like recessions of the past. Our entire economy was way too strung out. It was way too high, and now all they're doing is trying to bring it back down to normal levels. That is going to mean some negative growth, but it could mean our economy is at where it needs to be. Obviously, I don't, and nobody knows what the Federal Reserve is going to do next. Honestly, what the Fed does with its monetary policies are completely irrelevant because you and I, well, we just don't have control over anything that they do. That is why you need to be financially educated and prepared with your money, so that way when things do finally hit the fan, you are in the best position possible. You can capitalize on opportunities and you can stop suffering based on what the federal government or what the Federal Reserve is going to do or is not going to do. That gives you a level of financial freedom that pretty much nobody has in our economy today. And it's going to mean that you remain successful and thrive no matter the economic conditions. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.